Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is January 6th of 2024. So happy New Year to everyone. I hope that everyone had a safe, fun, and joyous holiday season. But it is the new year and it's time to get started. So, what we're going to go through this week is a little bit of our New Year's outlook. We're not a huge outlook shop, but some of the things that we're looking for in terms of market symptoms and what we're observing in the market. And when we've seen these prior symptoms in the past, what do we think this could mean for stocks going into 2024? So let's go ahead, get started. Um, the the title of this week's presentation is Will Stocks Collapse in 2024? Now, I do say that a little bit tongue in cheek because we've been in this 2 year cycle where just negativity has been persistent, it has been widespread, and it certainly has been fashionable. We actually do believe 2024 will be a year to make money. Now, we think it's going to look substantially different than last year. Now, obviously, last year we were up across the board, but our growth strategies in particular went up less than the S&P 500. And the big reason for that is because we have a value tilt versus a growth tilt in the portfolios, as we're preparing for what we think is this 10-year, or really call it 5 to 10 year cycle in the market, away from expensive growth and into value-oriented sectors within the market. Number two is that we think that this will be the year where we see the rise of the average stock. So last year, we look at the S&P 500 performance. Most of it, the vast majority of that performance was accrued from the very top of the market, right? So those top magnificent seven stocks, as we've come to know, like Apple, Google, Nvidia, Tesla, Netflix, Meta, those types of names. We think that this will be a year where returns are more distributed. Now, what does that mean when returns are more distributed? Well, that means that you're probably going to have more of a stock pickers market, more of a market where you're going to have to pick your spots in areas that people really haven't been trained on over the last few years. And then lastly, we do think banks and energy will be areas where we can generate significant alpha in 24. We've already seen some pretty good movements here in the first week, and we'll talk a little bit about that in this week's report. Real quick here, it is important to note that the S&P 500 before the first week of the new year, so last week, was up 9 straight weeks. The short-term bull market, bear market, neutral market, that is an overbought condition, right? And that doesn't mean the market's going to collapse. It doesn't mean the market's going to crash or correct or whatever. It means that it could go down a little bit. It could work that overbought condition sideways. It could work off that overbought condition where the frothiest areas of the market come down, but other areas of the market that didn't go up as much start to go up. It could mean all of those things, all of the above. The important thing here is that bull markets are often overbought. Bull markets spend most of their life in an overbought condition. So it doesn't necessarily mean you want to go here and short stocks or take money out of the market, but it could mean that you want to rejig the portfolio a little bit and say, areas that lagged last year, such as energy, such as the financials, such as certain areas of the consumer market, those could be areas of catch up in 24. May or may not be. Maybe you see continuation of tech, right? But some of the early indications that we see is that some of the very overheated areas, such as technology, might be primed for a significant pullback, while other areas of the market offset that pullback with catch-up rallies. And that's how we're trying to position the portfolios. Here you can see when we're looking at the current sentiment readers across the market right now, almost everyone's bullish short term, which is, again, an indication that maybe we get a little bit of a pullback here. When we look at flows, again, very aggressive as indicated by these blue bars. AAII Bull Bear Survey, very bullish. So again, from a sentiment perspective, things are overheated in the very short term. From a structural perspective, so When we look at the number of stocks participating in the rally, or we look at the number of stocks in positive trends, that is a structurally positive market, right? So it's okay to have an overbought condition when the vast majority of stocks are participating in the rally, in other words, wide breadth, and most of these stocks have strong trends. When you're in a bear market, you get an overbought condition. That's really where you do want to take that opportunity to offload some inventory. So the framework for 2024 is pretty simple. We do think that the 7 largest stocks, which together as a group were up over 80% last year, are showing some signs of fatigue. So we think as the Fed, well, first of all, we think the Fed is shifting away from attacking inflation to really preventing and managing inflation. And those are kind of iterations and evolutions, not revolutions in policy. We're certainly not in the camp of expecting 6 to 7 rate cuts, but we don't necessarily think you're going to see a lot of rate hikes from here either. We think that the Fed is going to take things slowly, and that slow approach may lead to the market pulling back a little bit in terms of those headline indices, but there are opportunities to make money underneath that surface. And so as growth expectations rise, right? So a big reason for people expecting recession is that the Fed's going to break something. Well, as the Fed steps back and people become a little bit less apocalyptic about the economy, we think that growth expectations are going to start to rise again for the economy, and that leads to a steeper yield curve. And when you get a steepening bond yield curve, in other words, where yields, long-term yields or interest rates are higher than short-term interest rates, value, small cap, banks, energy, industrials, those types of stocks tend to outperform their growth and large cap peers. And so that's the type of market that we're expecting in 2024. And when we look at sort of a threat index, right? So trend, momentum, and breadth. These are 3 things we come in every day in the office and we want to see. Those are all positive right now. Sentiment is very bullish, and that's a negative. Leadership is mixed. Technology is, we think, overvalued, overbought, and definitely primed for a pullback and showing signs of relative strength weakness, which we'll get into. So we'll call that neutral because that's offset by positive action in the banks and energy and consumer. Seasonal mix, especially with the presidential rally. And then credit remains great. The credit markets are our North Star. We have not seen a deterioration in credit, whether it's bond spreads, whether it's when we look at bank balance sheets and deteriorating loans. We're not seeing any signs of that right now. So that's obviously a very good thing. And then overall macro, industrial economy is a little bit slow, but consumer spending continues to hold up. And obviously, employment has been great as well. So going back to this idea that we're going to be moving away from the Magnificent Seven and toward the average stock. So the chart here on the left is the S&P 500 equal weight relative to the Magnificent Seven index. And yes, there is an index now called the Magnificent Seven. That is just an index. Is the sounds of those Magnificent Seven stocks such as Apple, Microsoft, Facebook, Amazon, Netflix, Google, and NVIDIA. I'm not sure if I mentioned Tesla, but in there as well. So you can see here that kind of bottomed out in the fall and is starting to break out. So in other words, the average stock is starting to outperform that Magnificent Seven index. And in fact, when you look at the equal weight S&P 500, since rates peaked on October 23rd, 2023, it outperformed the Magnificent Seven index by close to 4.7%. In other words, it was up 14% versus 9.2% for the group. What's more interesting is that as rates have bounced off their lows, it also has gone down less than the Magnificent Seven. So Magnificent Seven is down almost 5%, while equal weight is pretty much flat at down 1.9 or so. So again, both outperforming on the up and downside of rates, kind of showing a sign that the market might be in a position to more widely distribute returns in 2024. And we think Apple is just a great example technically. So when we look at the technicals, the chart action of stocks, we're seeing a lot of these mega caps that look a lot like Apple. And we're just using Apple as an example here. We can see significantly off its highs, try to make a run at 200 and it's all the way down into 180. So you're already talking about almost a 10% correction in the stock. What's more interesting though is the relative strength action of Apple. So while we haven't hit a low, the low point of 169, 170 that we saw back in October or so, we are seeing relative strength lows by the stock. And I think that's key. And we're starting to see that relative strength action roll over for not just Apple, but other stocks within the Magnificent Seven index. And so what does that mean for investors? Well, we think that does indicate a subtle but growing and more obvious shift away from growth and toward value, right? So here we've shown this chart a few times, but growth versus value, both large cap and small cap. We noticed that growth versus value started to break down. In other words, value started to outperform growth for small caps way back in the early fall. And that was an early sign to us to really start to shift the portfolio toward value. Now, our timing was off on that a little bit because obviously we had a big growth rally in the mid-fall time period. But as you've seen here, both in the latter part of December and the first week of January, value now is starting to assume leadership. And you've started to really see that in the large cap component of the market, where large cap growth is starting to significantly sell off relative to value. We think this is a longer trend move. We don't think this is a trade. We think this is trend, a new trend that's coming into place. So that's why, excuse me, that's why we really like how the portfolio is positioned for the new year. To be clear, that portfolio is positioned in value stocks relative to growth stocks. And we see that same action here in the banks. The banks are a big value component. And we can see here, small cap financials in particular, those regional banks are really breaking out relative to small cap technology. Chart here on the left shows the percentage of stocks both in positive trend and positive short-term momentum. And again, you're seeing a nice cluster in the top right corner of the chart there for the banks. This indicates stocks that, again, if you're in the top right corner, you got strong trend and strong momentum. That is a sign of a bull market. And we think the banks are in a bull market. So as breadth broadens out, we want to focus on stocks that we think benefit from a steepening yield curve as apocalyptic views around the economy start to settle down. Bank and insurance stocks we think are right up there. Energy and resource trade, it would be second in line there. And then, of course, small caps over large caps. So in summary, we want to stay focused on cheap businesses with good cash flow. It's that simple because we think that's really where multiples are going to expand. For those stocks like the Magnificent Seven that saw significant multiple expansion in 2023, we think this is a year for digestion and for correction, and we want to stay away from those areas. We do think the Fed pivot is setting up for a cyclical acceleration. Cyclical acceleration tends to align with value outperformance because value stocks tend to have lower multiples because they are more cyclical. Lastly, and ironically enough, lower policy rates we actually think may drive up long-term rates relative to short-term rates, hence that curve steepening call. So that's what we got for you this week. Again, a little bit of a glimpse to how we're looking at 2024. We'll provide more color as the year goes on. But we're off to a good start, and knock on wood, that continues. But I think that we got some good trends in place underneath the surface of the market. We've set up portfolios that are significantly different than the index. And I think that, given where we're at in the macro economy right now, I think we're in the right areas. So give us a call if you have any questions, 888-543-3776, or reach out to your advisor. Thank you and have a great week.